Many of you may be wondering why gold price is in the doldrums again. By the way, I was a buyer of gold stocks today, and not just to show confidence. I think we're very close to a bottom, but the problem is a narrative, as it often is with gold. Vaccines and a reopening of the economy are risk on. Real growth this year will range up to 8%, according to most of the predictions out there, 6 to 8%. There will be some temporary inflation from base effects, but nothing serious. The surge in yields is primarily due to growth, not inflation. It's peaked and it will subside. So, with all that good news, who needs gold? And much of this is based on the Fed's latest fairy tale forecast. They're really good at these things. It's too bad that none of them ever work out. The Fed has upgraded its real growth forecast earlier this month to 6.5% for this year. And no upgrade, by the way, to 2022 and 2023. 2021 inflation, 2.4%, but don't worry, it's transitory. Inflation will fall in 2022. The Fed does not, it says, fully achieve its 2% inflation target until 2024, and it will exceed it until maximum employment is achieved. But at the same time, the Fed is committed to anchoring inflation expectations at 2%. Figure that one out. No actions are needed to curb rising yields, so everything is just hunky-dory. QE of 120 billion per month, which is no small matter. It's actually more than QE3, and that will continue. Increases in the Fed funds rate won't happen until maximum employment and inflation targets are actually met. And that's projected to be 2024. So it's free money until then, at least. Now, there's some problems with this. And one of them is that inflation expectations have already pushed beyond the 2% benchmark. And in fact, the market, the bond market, especially credit markets, think otherwise. Not the stock market yet, but we think that's coming. The Fed wants inflation, but not the inevitable effects of inflation. That's magical. The Fed says inflation rates can be managed with pinpoint control when that's never been done historically. They can't be easily controlled when they arise. Anchoring inflation expectations at 2%, as I said, has already been lost. You can see the chart on the 5-year break-even inflation rate over on the right. And inflation, therefore, I would say is the Achilles heel of Fed policy. They're all in with respect to inflation, and when they are proved to be wrong, which we think is not more than a quarter or 4 months away as we get more data, the Fed will dump its forecasts within that period and implement yield curve control. So they'll sit on the long end of the yield curve and keep it down, and gold will soar to at least $2,300 an ounce and possibly higher. There are four, so next slide, there are four drivers of inflation in our view. One of them, the classic one, demand pull inflation. That's where we pay lots of people to stay home because we want to increase demand in the economy. But of course, at the same time, we're not increasing goods and services. Ray Dalio has a name for this. He calls it monetary policy 3. I'll just quote from him a bit. When interest rate policy doesn't work anymore because you're at zero and growth has slowed down because of the debt load, monetary authorities always print money by monetizing debt to help those who need it, and that brings inflation. And this has been the history all the way back to the Roman Empire. There's nothing new here, and nothing like this works. So if you look at the slides we have here, the charts, the first one from Jeff Gundlach, you probably recognize some of these, shows that personal income of Americans, the percentage of that from government transfer and assistance payments has been as high as 31.5% in the very recent months. and is now floating around 27%. It's absolutely staggering, and it's going to go up again as the new stimulus package passed by Biden plays out. The next slide over tells you why this is necessary and why Ray Dalio concedes of monetary policy 3. This is a measure of real growth in GDP minus the increase in the federal deficit. In fact, US economy, apart from the US deficit, has not grown in real terms since 2007. That's why, for the vast majority of Americans out there, it doesn't feel very good. Real growth is absent. Therefore, all the stimulus that continues to be required long after the Great Recession and now into the current COVID experience problems. And so go to the right, it takes about $12 in support of various kinds from the Fed and the Treasury to generate $1 of economic growth. So here's an interesting quote just to support all this from our Federal Reserve Bank of St. Louis. Quote, a solution some countries with high levels of unsustainable debt have tried is printing money. In this scenario, the government borrows money by issuing bonds and then orders the central bank to buy those bonds by creating, that is, printing money. History has taught us, however, that this type of policy leads to extremely high rates of inflation, bracket, hyperinflation, bracket, and often ends in economic ruin. That's from 2 years ago from our own Federal Reserve Bank. Thanks for explaining where we're headed. Next slide. The second driver of inflation is cost push. Some people think you can't get inflation without cost push, but we're getting it now. Peter Bookvar, a very well-known economist, has figured out that if you take the jump in average hours worked plus the increase in hourly earnings, you actually can figure out that year over year, labor rates are up 7.5%, because from the business point of view, that's what they're paying. This is, of course, a lot more than just following average hourly earnings would tell you. Weekly earnings are up substantially thanks to overtime. And it stands to reason that this would be the case because, as Peter says, why would anyone go to work today at pre-COVID pay levels? They've been paid to stay home, some paid rather well. And there's a sniff of inflation in the air. You can see that in the public opinion polls now. 77% of Americans think inflation is going to rise. So you hold out for more money. That in itself is inflationary. So next slide. The fourth driver of inflation. This is from Jim Grant. It's kind of my favorite, but I'm a fan of Jim Grant, interest rate observer editor. His comment is that it's the fiscal situation of a nation that really triggers inflation in the end, and it did in Germany between the wars. I'll read you his quote. What history shows is that inflation is often a collective behavioral phenomenon. A loss of confidence in a government's ability to service and repay its debt results in a repudiation of the country's bonds and an inflation caused by currency weakness. A confidence crisis like this occurs suddenly rather than in a predictable mechanistic manner. Think tipping points. So if you look at the charts on this page, the upper one tells you what happened to M1 money supply, its rate of increase, after the Great Recession. And you can see that, despite all the QE, which ended in 2014, the increase in money supply was about 7.5%. Not that significant in overall terms. Below, you see the chart that comes from our COVID experience, where we're now seeing an increase in money supply, M1 money supply, of 36, 37% year over year. It's unbelievable what's happening. We haven't seen anything like this since the Second World War, and at least then we had a reason to do it. This is leading to a lot of people suspecting that our dollar can't be counted on. And if you look at the numbers, we got, in terms of Treasury stimulus, 3.1 trillion from Trump, plus another 0.9 trillion during what I call the interregnum before Biden took over. Biden's 1.9 trillion already passed, and now to be followed by US 3 trillion in infrastructure and green investments, except yesterday he said 4 trillion. I don't know if it was a lapse of memory or he's just upped it. So that's 8.9 trillion to 9.9 trillion in addition to regularly scheduled operating deficits, which the US has had since forever. So next slide. The fourth driver, and this is one that involves our foreign friends. Who owns the dollar and how much of it? Foreign investors actually have $25 trillion worth of US securities and cash. If foreign investors no longer want the treasury debt that's denominated in the reserve currency, and they don't, as we'll see, then the Fed is going to have to buy much more, and the dollar is going to go lower. The first chart, US twin deficits, this is always a good leading indicator of where the dollar is going. Of course, you can have little counter trend rallies, but it's going down because the twin deficits are headed much larger, as you can see, been nearly to 27% of GDP. That's unprecedented. Now currently popped up to around 23%. And then to the right, if you look at that chart, the red line tells you where the deficit is headed. So, about 2.4, 2.5 trillion this year. The blue line is the amount of federal debt held by foreigners, international investors. And as you can see, it's evaporating. It's not there anymore. This has a very important effect. Foreign central banks for decades have been sterilizing the US deficit. What does that mean? They bought the bonds, they held that in treasury, in their own central banks, and so it did not manifest in the market. We didn't get an inflationary effect from the deficit, or both deficits. But now they're not holding on to that debt. It's coming back to the market. That's going to overwhelm the Fed in terms of the amount of printing it has to do to support the market. And we won't be seeing any more this process of sterilizing US deficit. Next slide. So what we're predicting is that this is probably the Fed's last rodeo. Not that there won't be a Fed, but it won't have any decision-making power anymore. The Fed is in fact out of options, and it has to hope for transitory inflation, or it is going to be fully exposed. They cannot tighten financial conditions to fight inflation because that will crash markets and the economy. We know that the economy cannot handle even the smallest increase in the Fed funds rate. And also, they cannot allow the long-term rates to continue to escalate, because that too will crash markets and the economy. So they will be left with the only option of suppressing long rates, yield curve control, and that will collapse the dollar, as Louis Gave has said, and I've stated in the past. So get ready for a 20% drop in DXY. Won't happen all at once, but it will happen in an accelerated manner. So just to sum up, on the left, the chart tells you where we have been, which is disinflation. Financial assets have done real well. It's been a happy time for the stock market, and anything real has tended to trade down. But now we're going into what we would call a real bull market for gold, which is the one on the right, the famous one we got in the 70s, because that's what happens to real things when inflation starts to click. With that, David, back to you.